Once upon a time, in a galaxy far, far away, there lived a pig on planet Earth. Pig was an accountant, but she was lonely as she had no accounting friends to talk to. All of a sudden, a flurry of white flew down from nowhere. Whoa, who are you? Where did you come from?
I'm Goose. I was sent here from Uranus to learn Earth's spectacular accounting methods.
Lucky for you, I'm an accountant. What do you want to learn about today?
I want to learn about what you guys call inventory.
Ooh, inventory. What do you know about inventory?
I know you count things.
Fair enough. That's true. There's also a lot more to it. It is very important to take a physical inventory of goods on hand. But it is also important to figure out who owns the goods. Hint, it's not always the business that owns them. If we buy something and somebody is shipping it to us, if we have paid for the shipping during the accounting period we are in right now, it counts in our inventory. If the seller paid for the shipping, we don't count it in our inventory. Does that make sense? Honk. Now, I'm sure you're wondering, why is the cost of the inventory important? So, it's important to know the quantity and the cost of the merchandise we have on hand. This is important because we need to figure out our profit. To figure out profit, which is very important in the accounting world, we need to know the amount of the sales, which is how much somebody paid for merchandise we sold, and the cost of goods sold. The cost of goods sold is the total cost of merchandise that was sold in the period, and the cost is that we, as the business, paid. Quantity is figured out by physically counting the merchandise, as you already said. Great job.
Thank you.
Honk. Cost is determined by one of the three methods that I will mention in just a minute here. Now, I want to know if you have any questions so far.
How often should you do inventory costing?
Excellent question, my dear duck friend. You can either do it perpetually, which is all the time, or periodically, which is every once in a while. Most people do it perpetually, though.
Hey!
Bum bum bum.
Got any grapes?
I'll give you grapes if you listen to me talk about inventory. But first, where are you from?
I'm from Saturn.
Oh.
What brings you to Earth?
Well, you see, I've traveled a lot of places, and I heard that Earth has grapes. Everywhere else I've traveled has only had lemonade.
That sucks.
Yeah.
Well, lucky for you, I have grapes in my inventory.
I'm gonna stay here until you give me grapes.
Okay. Where were we, Goose?
We were talking about the different types of inventory costing.
Ah, right. So, there are three general types of inventory costing. The first one is the most simple to learn. It's called specific identification. Say you have 3 different cars. When we sell them, we can document the sales very easily. The second method of inventory costing is FIFO, which is also known as first in, first out. This method assumes that the oldest goods are sold first. So the cost of the earliest goods bought are the first to be recognized as the cost of goods sold. And the cost of the most recent goods bought are generally the ending inventory. This often accurately reflects the actual physical flow of merchandise.
Cool! Honk!
Can I have my grapes now?
No, we're not done yet. So the third inventory costing method is called weighted average. This method assumes that it is not possible to measure specific flow of physical inventory. Think marbles because they're identical. Therefore, inventory costing is based on a weighted average unit cost, which means we take the cost of goods available and divide that by the total units available and use that number as the cost. The cost may change after a purchase, which affects the inventory balance and the cost of goods sold balance. This cost calculated is used when goods are sold. We apply the weighted average cost to determine the cost of goods sold, and then we apply it to the units we have on hand to determine the ending inventory. If we do perpetual inventory, a new weighted average is calculated after each purchase, which means that average is then applied to any unit sold, as well as any units on hand to figure out ending inventory. All of these methods will have a different effect on our ending profit. With the FIFO method, if prices are rising, then FIFO produces a higher profit. And if prices are falling, the opposite occurs. FIFO also provides the most current valuation of inventory, and it more closely approximates the replacement costs. Well guys, that about wraps it up for today. Do either of you have any questions?
Honk, I do. Do different situations call for different methods?
Great question, Goose. Yes. If there is if an item can be identified specifically, as in vehicles or maybe unique paintings or plants, then you would use the first method, specific identification. If it's possible to measure the specific physical flow of inventory, meaning you can keep track of what comes in and when and what the cost was, then you should use FIFO. If it's not possible to measure the specific physical flow of inventory, like earlier mentioned marbles or bulk candy or nuts, then you should use weighted average. Most of the time, you should use either specific identification or FIFO because they are the most accurate and will give you the most accurate inventory and profit for your financial statements.
Thanks, Honk.
Thank you, Pig.
You're welcome.
Can I have my grape now, please?
Yep.
Thank you. Goodbye.
You're welcome.
That was really informative. I'm going to take all of this information back to Uranus with me. Thank you for helping me learn more about inventory. Honk!
I'm so glad I had other animals to talk to about inventory. I don't feel lonely anymore. The end.
Yeah. Actually, it would be hilarious if he like walked underneath, but like his tail was in view of the camera. Hey!
Bum bum bum.
Oh, I forgot. Sorry. We'll do better.
Who are you?
I'm from Saturn. So sorry. You just smacked your butt with Saturn.
I don't know if that should be or. Oh no!